So today I want to talk to you about investment loans to buy real estate. This is truly one of the most common questions that I get from my clients and people who simply are interested in investing in real estate, but just don't have enough knowledge, don't have, the know-how of the financing, how it all works. And well, if you're one of these people, then maybe this video is for you. So look, this video is going to be a little bit lengthy. So to make it a lot easier to consume, make sure that you check out the timestamps in the description below. I'm going to cover as much as I can all of the different stages of investing in real estate. So I'm going to break it down all the way as, from starting in real estate investment. So maybe you're a first-time home buyer, you have no properties, but you're interested in buying real estate to, maybe you're buying your first property that is going to be an investment, or your second, or maybe you already have a little portfolio of homes and you want to move on and understand a little bit more of the more complex financing. Or maybe, you are looking into doing something like property flipping, right? So you want to know about home flipping financing, ground up construction. So I'm going to touch about those things in this video. And obviously, those last ones, we're going to leave it for people with a little bit more experience. So anyways, let's go ahead and get started into this whole thing. All right. So you are basically a total newbie. All right. In this whole thing, you are a first timer. You're interested and you want to know how to get into the whole real estate game. Either you're looking for long-term financing, right? For maybe you want to turn a property into into a long-term rental, or maybe a short-term rental, like maybe Airbnb, Verbo, something like that, right? Okay, so the way to get started in real estate investing is truly by starting with your first home as being your first primary property, okay? This is honestly the easiest and best way because I don't want you to buy this home as an investment property right away, okay? Because when you buy an investment property right away, you have a lot more restrictions. You have a bigger down payment and things like that. So when you have the ability to buy a primary home, you're going to open a door for, probably more options, right? You're going to get options for low down payment. You're going to get options for like lower interest rates and things of that nature. So there's a lot more advantages right away when you buy a primary home. So this obviously basically means that I want you to look for homes in an area where you live, okay? Don't go out looking for investment opportunities in the Midwest because you saw some guy on TikTok that, says that houses in Iowa are selling for $200,000, but you live all the way in Seattle. You know what I mean? That doesn't make sense. You have to stick around where you live first, even if you live in a high-cost area, okay? With your first home or your primary home, you want to do a conventional mortgage. If you're a first-time home buyer, you can do like 3% down. If or you can do an FHA loan with 3.5% down. If you're a veteran, take advantage of your VA benefits. Do a VA loan with no down payment. If you live in a rural area, do an USDA loan with no down payment, okay? Or look, maybe even if you don't have any money, look into down payment assistance. Look at grants, things like that can be offered for you, especially if you're a first-time home buyer. Just get the experience of home ownership, okay? When you do this, you can house hack. You can buy a property that has an in-law suite, right? Rent out the basement. It helps you pay for the mortgage. Maybe buy a duplex, buy a triplex, buy a quad, live in one of the units, rent out the other ones, and then whatever the case is, live in it for a year or two. Then you're going to move out of the house. You're going to rent the whole entire property. You're going to turn it into a rental. And then you're going to buy your next home, which is going to be your new primary property. And then you're going to do this whole thing. And again, when you buy a primary home, you get to enjoy lower interest rates. That's just basically the way how this works, especially if you do a type of government loan like conventional FHA, VA, USDA, okay? You can probably continue this whole entire game for maybe 3 to 4 years. Theoretically speaking, maybe you can do it for a little longer. But then it becomes a little bit difficult, right? To always have to move every year or so. And then at some point, it just kind of becomes almost impossible to continue to do it anyways. Just remember that if you buy a primary home, you need to live in the house for at least 1 year before you rent it out. Otherwise, you're going to be committing mortgage fraud, and you definitely don't want to do that. So that's what I want you to do, okay? First home, buy it as your primary, all right? And do a regular mortgage. Lowest down payment, lowest interest rates. You don't have to have amazing credit. Get the experience. Buy it where you live, okay? Now, let's talk about the next step into the progression of becoming a real estate investor. And then now let's talk a little bit about buying your first investment home, right? But before you do that, I want you to do this if possible, whenever possible. And that is, I want you to take out a home equity line of credit on your primary home. You're probably wondering, why do I want to do that? Well, because a home equity line of credit allows you to tap into the equity of your home and use it for whatever you want. That could be to purchase another home, right? Maybe you don't have enough money for a down payment on the next one. Well, if you have equity that you can tap into on your primary, then you now have money to go and buy your first investment home, right? Or maybe you buy a home that, maybe needs some repairs. Well, you have access to your equity to do those repairs as well. So, if you have equity in your property, in my opinion, you should almost always have a home equity line of credit. I mean, just think about it as having a credit card. If you don't use it, you don't have to pay anything. You have no interest, right? But if you do need it, then you can come and access it. That's why it's so important. So, I think it's just like good financing, to be honest, is to have that access to your equity whenever you want it. All right. So give you an example. Say that you own a home worth $500,000. You owe $300,000 on it. You have $200,000 in equity. With a home equity line of credit, you can probably access all the way up to 90% of the loan to value or the equity of your home, which means that you can take, about $150,000 on a home equity line of credit. So again, you can do whatever you want with it, or just sit on it, do absolutely nothing, right? Until you find your first actual investment property opportunity. So let's talk about it, right? If you are buying your first investment home, my recommendation for most people is to do a regular conventional mortgage, okay? It's a conventional mortgage for an investment property. And with this, you can do a standard 20% down. So as long as you have good credit scores, you're going to have a better interest rate than doing something like a commercial loan, which we're going to talk about later in this video as well. Now, the downside, obviously, with a conventional loan is that, it's going to be on your credit report, all right? You cannot title the property to an LLC. A lot of people always ask me if they can put an investment home, their first investment property, they do a conventional loan and put it under a business. The answer is no. The answer is always going to be no, okay? Because these are, government loans, and they want it to be done under a real person. So those are some of the downsides of a conventional loan. The other one, obviously, is that it's going to look at your personal income as well. So you're going to need to show proof that you make enough money to qualify for the new house as well. But it does have one cool little trick, and that is when you get an investment property with a conventional loan, then the lender can actually use up to 75% of the projected rent payments and use it towards the qualifying income that you're going to use on the application, okay? So, that's going to go a long way, because if you don't make enough money to have two mortgages, well, if we use 75% of the projected income of the subject one, then that might actually put you over the hump, okay? So if you have maybe used the little trick that I talked about of like buying a primary home, living it for a year, then, moving, then doing it over and over again, then you have better put those rental properties on your taxes, and you got to make sure that you have positive cash flow on those tax returns, right, from the investment properties that you already own. Otherwise, you're just not going to qualify for a conventional investment loan. At least the odds are going to go down drastically, because, again, one of the downsides of a conventional mortgage is that it's always going to look at your personal income. And if you have investment homes already, they're going to look at your tax returns, okay? So that's basically how that goes for a conventional mortgage. For an investment loan, at least for an investment property, the best interest rates are available when you put down at least 25% and you have a credit score over 740. Now, you're probably wondering how many conventional loans can you have at one time? That will be a really good question, because there is a limit on how many conventional mortgages you can have at one time, and that is set at 10. So it's still a pretty good number, but I mean, it is a lot of exposure. You know what I mean? Like, what if one of the houses goes belly up and then now you face foreclosure, right? So you probably don't want to have a lot of exposure. A lot of people who are investors don't really put 10 mortgages on a credit report. It's just not, it's not really the best thing to do. You could do it all day long. I kind of stay away. So anyways, this is where we're going to move on to the third stage in the life of a real estate investor. And again, this is not, this is not something that I will do for my first one. for some people, it's the only option. So it's still a good option, obviously. But this is where a DSCR loan or debt service coverage ratio loan comes in. This is, again, the next step in the evolution of you understanding investment properties. This gets a little bit more complex, but it's actually a lot of fun. You better believe that you want to know about DSCR loans if you want to continue to invest in real estate and you want to have multiple properties in your portfolio. So you really want to know about this option, okay? So listen up. DSCR loans are basically, best way I can explain it to my clients is they're kind of a hybrid between residential and commercial mortgages. They're a hybrid because you can buy a single family home, right? Residential. But the loan itself comes from the concepts of commercial lending, okay? This loan is literally mainly based on the property's ability to generate enough cash flow to cover the mortgage payment. So this means that your personal income is not factored in. Doesn't matter. If you make $200,000 a year, on a W-2, $100,000, it doesn't matter. Your personal income does not matter with this loan. The biggest thing is, can this property meet at least the mortgage payment, so cover the financing, or make more money than what the payment is, okay? This is really how you can grow a portfolio of properties, because normally, your income, your personal income is gonna be a limiting factor when you have a lot of exposures with multiple mortgages or multiple, real estate. So no personal income is needed here, okay? You never have to show your taxes, your W-2s, or anything like that. Now, the other things that are important are your credit scores. They're factored in because it does need a personal guarantor, and that means you got to show your personal credit, not a company's credit. People ask me, can I do my, Dun & Bradstreet credit score, for my LLC? Answers no, it's going to be your personal credit, okay? The other thing that you need to know is, you're going to need money, right? Hell, I think I should have said this, like with investment loans, you're always going to need money when it comes to buying investment properties. Right now, the lowest loan to value allowed by most DSCR lenders is about 80% or 20% down payment, but it's not uncommon to see a 25% down payment being the minimum, okay? With DSCR loans, the biggest factor, again, is going to be the debt coverage ratio. This is basically the property's ability to generate enough cash flow compared to that mortgage payment. How this works is like this, but it's going to be very simple. A debt coverage ratio of 1 means that the property generates enough cash to cover the mortgage payment, right? So if you can rent the property for $3,000 a month and your monthly payment is $3,000 a month, then that is a ratio of 1, okay? If the debt coverage ratio dips below 1, right? So that means that there's not enough income generated by the property to cover all of the expenses. And obviously that will be more riskier for investors, right? For lenders, because that means that, you're going to have to pull out money from other sources to make up the difference of the income versus the outflow, which will be, the mortgage payment, right? So when you have a DCR of under 1, the lender's probably going to ask you to put down at least 25%. And your interest rate is also going to be higher because it's riskier. Risk equals interest rates. The riskier a loan is, the higher the interest rate is, okay? On the other hand, if the debt coverage ratio is above 1, that means that there is more than enough income being generated by the property to cover all of the expenses. And really now it's considered a pretty reliable investment for the lender, right? A pretty good collateral. So, and that's honestly ideally where you want to be. You want to have a debt coverage ratio over 1. And especially if you want to have the best credit score, the best interest rate, you want to have a debt coverage ratio over 1.25. This is like literally having an 800 credit score for a property, okay? In this case, you're going to be able, especially when you couple this with a great credit score, you're going to be able to have the best interest rates that the loan can offer, okay? Now, I want to go ahead and mention 2 big things that you need to know about DSCR loans, and that is something that you just have to know, okay? You can't get away from them. It's like impossible. Now, the first one is going to be fees. When you get a DSCR loan, you can expect to pay higher fees compared to a conventional mortgage. A lot of people get confused. A lot of people get sticker shock because they're only used to a conventional loan, FHA or something like that, and it's a lot cheaper. With DSCR loans, again, these are commercial mortgages. This is kind of where we start talking about points. Okay, you're gonna hear this term a lot, especially the deeper you get into real estate financing, investment financing, and those are points. Basically, what that means is origination points. Depending on the broker or the lender that you go to, you can expect to pay anywhere between 1.5, 1.875%, all the way to 5% in origination fees alone. So if you're trying to finance a $500,000 purchase price and the broker, the lender is charging you 3% as an origination, that's $15,000 in origination fees only. Okay, so this is going to be something extremely important for you to know. It's also, origination points will also get influenced by your credit scores, your down payment, and your loan amount. The higher the loan amount, probably the lower the percentage of origination is going to be. Meanwhile, like the lower the purchase price, the lower the loan amount, then, just the lender has to make money somewhere. You know what I mean? So they're going to charge you probably higher percentage origination points. The loan really moves a lot based on your credit scores. I recommend a lot of people, especially if you start getting into something like this, just have a credit score over 720. It's going to get you better interest rates, better origination, and all those things. Okay. The second thing is going to be your interest rate. All right. So generally speaking, DSCR loans have a higher interest rate compared to conventional mortgages. That's just, it's just a fact. Normally, a DSCR loan can have a interest rate that's 1% to 3 percentage points higher than a regular traditional conventional mortgage. And again, it could be even more depending on that debt coverage ratio that we just talked about. So, when you have a lot of factors that go against you, that interest rate is going to go up. Okay. So that's, the riskier the loan is, that's just, kind of how that goes. The other thing that you definitely need to know is that DSCR loans, they all have a prepayment penalty. All right. That can range anywhere between 0 years, so no prepayment penalty, to 5 years. But there's always a prepayment penalty. What this is that this is a fee if you pay off the loan before a certain amount of time. Normally 5 years is the longest prepayment penalty that they'll give you. If you plan to refinance because interest rates went down in a year and you have a 3-year prepayment penalty, then you're going to get penalized. Normally it's about 5%. So you got to keep that in mind because it can be a lot, So make sure that before you do a DSCR loan, ask about your prepayment penalty. You can, however, opt out of having the prepayment penalty, but you're going to have to pay for it. Either you have a higher origination or maybe you take on a higher interest rate. Those two things typically can get you out of having a prepayment penalty. Typically with my clients that are investors and we do a DSCR loan, I advise them, as of right now, I'm making this video in 2024, in March, we're probably expecting rates to go down towards the end of the year, maybe next year in 2025. I advise them to not take a prepayment penalty of more than 2 years because in that way, they're not stuck, if interest rates go down. The longer the prepayment penalty is, so like if you take a 5-year prepayment penalty, the better interest rate you're going to get. And obviously on the contrary, if you take a no prepayment penalty or a short prepayment penalty like a year, it's going to have an interest rate higher on your note than a 5-year prepayment penalty. So just kind of keep that in mind. Do your numbers. Hopefully you work with somebody who's really good at DSCR loans to help you understand the differences between having those prepayment penalties, okay? Some people it's better off to just not have it whatsoever. DSCR loans have a lot of advantages that you just don't get with traditional mortgages. So, for example, one of them is, you can title the property to an LLC, right? So it can actually close under a business. The DSCR loan can be literally structured as a commercial note. So this mortgage wouldn't even show up on your personal credit. That's how much more powerful these DSCR loans can be over regular conventional mortgages. The other thing is you can finance small scale multifamily properties with a DSCR loan, like more than 4 units, So with a regular mortgage, like conventional FHA, whatever, you kind of limit it to 4 units. While DSCR loans, you can literally go all the way up to 30, 40, 50 units on a property, small apartment complex. As a matter of fact, we helped a client in Florida closing a 10-unit apartment complex because of a DSCR loan. That wouldn't have happened with a regular mortgage. So that's why DSCR loans are so powerful. They allow you to do just a lot more than a regular conventional mortgage. Okay. So again, just to kind of recap, this is where I will go if I have more money. You have really good credit scores. You have so a little bit of background in real estate investment. You want to do a DSCR loan. All right. Definitely have to know. You're going to have to do it at one point in your life. I want to go ahead and now move on to renovation loans for investors. This is obviously you're interested in flipping houses, right? So this is what we call fix and flip or rehab loans. In some cases, this is what you probably hear about hard money loans. I'm not really going to talk about hard money loans because, hard money is sort of given by a regular mom and pop investor who has money on the side. They just want to go and invest it. They'd rather, lend it to somebody at 15%, 20% than have it on the market, at 5-7% in an IRA or something, right? So fix and flip loans are usually given by investors, right? Institutions where you're going to have to go through an underwriting process. Getting a fix and flip loan is a lot easier though. I mean, you can close on a fix and flip loan as little as 7 to 10 business days, depending on what state you're in. They are literally commercial notes. So no personal income is going to be needed when you get a fix and flip loan. It's not going to close on your personal name either. This is strictly an investor loan. You have to have an LLC to do it. It's going to close under your LLC, but you're still the personal guarantor. So your personal credit score is taken into consideration. With a fix and flip loan, you're going to have the opportunity to obviously purchase distressed property, outdated property, rundown, whatever, turn them into a really good profitable asset. The typical repayment period for a fix and flip loan is about 12 to 18 months, while the payments are interest only. So you're only paying interest every single month until the note is due, which again, it's roughly up until 18 months. So you have to pay it all back in 18 months. You got to make sure about that, okay? As of, interest rates, as of right now when I'm making this video in March of 2024, most fix and flip investors that we, for example, that we deal with have interest rates starting in the 10.5%, 11% range, assuming you have a great credit score and assuming that you have a really good property as well. Origination points, just like a DSCR loan, have to be taken into consideration because they're going to be higher. Normally speaking, a fix and flip loan can start with a 3 to 5 points on average for origination. So understand those things. Now, the biggest things that you need to understand about fix and flip loans, in my opinion, are ARV and loan to cost, or LTC. And ARV stands for after repair value. It's the estimated value of the property once it's being renovated. And this value will determine the maximum amount that you can borrow for your fix and flip project. Lenders typically lend up to 90% of the purchase price and 100% of the renovation cost, but they limit the ARV to 70 to 75%. In some situations, depending on your experience as an investor, they might go up to 80% ARV. Experience is typically determined by the amount of properties that you flipped in a 2-year period. And from my experience, once you kind of have 3 properties under your belt, you are already considered an experienced investor. It's really good to establish a relationship with a fix and flip lender, or at least a broker that does deals with fix and flip lenders, because your name is going to come up and you will get better treatment. You're going to get better terms. So just kind of keep that in mind. This is not something that I would try to shop around like as you would shop around a regular mortgage. Okay. Renovation loans really are a great way to get into fix and flip projects without tying up a lot of money. And by the way, when you understand fix and flip and you understand DSCR, you can piggyback both of them if holding on to the property after fixing it is your exit strategy. That's what we call, you are on a holding exit strategy. This is basically how the BRRR strategy works. You probably heard about it multiple times if you looked at, real estate investment videos, right? BRRR stands for the buy, the rehab, refinance, rent, and repeat strategy, right? So that's literally what it is. It's a popular method, and this is how investors get to do this method of BRRR: is do the fix and flip, find a good property that has some good after repair value, then Once you finish it, you're going to do the DSCR to refinance it, either take cash out so that you can go and buy the next house if you have enough equity, or you have the permanent financing, right? Until you get enough equity and then you take the cash out, okay? So that's how BRRRR works. I would say that's like the fourth stage of becoming a real estate investor with a lot of knowledge, okay? Okay, so we're coming along to the tail end of this video. So let's go ahead and talk a little bit about ground up construction. If you're looking to get into the world of building a property strictly for income, a new construction loan for builders, for investors are available. You could do this. And this could be whether you have a shovel-ready lot or a tear-down project or rundown home that you just need to just completely gut, destroy, whatever. These loans are really good for spec houses, model homes, tear-downs, build subdivisions even, right? I mean, even if you're taking a good amount of money, you can even build a subdivision, 2, 3, 4 houses, right? Usually, and actually, before I even say that, you can even do a multifamily home. You can do a duplex. You can do a triplex, quad, whatever, 5-unit. Doesn't matter. So as long as you have the criteria, you can do a new construction loan for this. Now, usually a new construction loan requires a minimum down payment anywhere between 20 to 30% down. So 70 to 80% loan to value. And I would say I will always err with the 70% loan to value. So just be prepared to put 30% down, okay? It does have a maximum loan to cost ratio of anywhere between 85 to 90%. I didn't explain what loan to cost was, but basically this is really important to understand. Whether you're doing a fix and flip or you're doing a new construction, loan to cost is basically the representation of the percent of the loan that the lender is going to provide you in financing compared to the hard cost of building the project. That's literally like the definition of it. Basically what this does is like it helps the investors see how much money they need to have on hand to help fund the project. Most new construction lenders might only cover up to 80% of the construction cost. So it will require you, right, the project owner or the investor to put down the remaining 20%. I'll give you an example, easy to understand with an example. If you're buying a $500,000 property, the construction cost is $400,000 and your maximum loan to cost is capped at 80%, then the maximum loan that they will give you will be $800,000. Assuming you have a good ARV, the after repair value and all that stuff, okay? So obviously that means you need to come up with $200,000, okay? So honestly, and this is kind of my closing thought, when it comes to getting more and more complex with these, investor mortgages and investor financing, you want to understand loan to value, all right? Like know that in and out. You want to understand after repair value. And you better know how to evaluate a property before you get it under contract or when you get it under contract. Because a lot of people, especially our first-time fix and flip investors, get burned from not doing a good analysis on what a property can be worth after they do all the things that they want to do. So after repair value is extremely important. Loan to cost, know that 100%. Debt coverage ratio, we talked about it with the DSCR loan. And then finally, which I didn't really cover in this video, I didn't think it was that necessary, but that's the cap rate. Those things are extremely, extremely crucial, okay? And finally, guys, these are really my closing thoughts is, look, whether you're a first-time investor or maybe you're somewhere in the middle of your real estate investment experience, it's so important for you to have a solid business plan in place before you start out seeking financing. Maybe not so important if you're just buying your first home, okay? But if you're looking like, okay, I'm looking for my first true investment property, have a really good, solid plan in place. Know exactly what your target market is. Know exactly what kind of property you want, what kind of tenant you want, what kind of things you are ready to deal with if something goes wrong. You know what I mean? Like you have a bad tenant, your property breaks down, you have to do some repairs, whatever. You know what I mean? It's extremely important for you to have a good, solid business plan so that you don't end up having something really bad with your financing or your finances happen down the road. So like, for example, and honestly, I think this message is a lot more granted for people who are like getting started is do not commingle your funds, right? With your tenant giving you a rental, for your rent, right? And have that in your personal checking account. No, you want to have a separate business account for each property that you have. Okay, it's just honestly, it's going to help you a long way. It's going to keep you more organized. Again, you have to treat it like a business. Get yourself a bookkeeper, get yourself a good CPA that's going to help you save a lot of money with taxes. Okay, so definitely understand all those things. And finally, I mean, as you guys see through the progression of this whole video, the more complex that we got, the more money it is that you need to continue, right? But the good thing is that once you get past doing a regular conventional mortgage and you start doing like a DSCR loan, a commercial loan, a fix and flip, new construction, you can now partner up with people. You can have a couple of people in an LLC, go 50-50 on a partnership, whatever, just make sure that whoever you go into business, that they also have, the capacity, right, to invest in the business, but also have good credit scores. It's going to be really necessary. Okay. But you have a lot more things. You can raise money. A lot of like the nuances of a regular mortgage, like a conventional loan, don't really matter in commercial lending. So, that could be, hey, we put together some money, right? So as long as you can show it and it didn't come from like an illegal source, then you're good. There's no income necessary or anything like that. So capital really becomes more and more important. But again, you can just partner up with people. So anyways, hopefully you guys found this whole video, very useful. If you have any questions, if you have any comments, any thoughts, just put them in the comment box below. And I appreciate you guys watching it. And I will see you soon. Take care.